The Florida real estate market is on the brink of collapse. Wall Street giants are scrambling to offload properties at alarming discounts, signaling a potential market crash that could reshape the Sunshine State's housing landscape. Let's start with the facts. In the past 6 months, we've seen a dramatic increase in the number of properties being listed by institutional investors in Florida. According to data from the Florida Association of Realtors, there's a 35% surge in listings from LLCs and corporate-owned properties compared to the same period last year. This isn't just a small fluctuation, it's a seismic shift in the market. But it's not just the volume of listings that's catching attention, it's the prices. We're seeing discounts of 10 to 15% below market value on many of these properties. In some cases, the discounts are even steeper. For instance, in Miami-Dade County, a portfolio of 50 single-family homes was recently listed at an average discount of 18% compared to their last appraised values. Welcome to today's video, where we're diving deep into a developing story that's sending shockwaves through the real estate world. Today we're uncovering the truth behind the mass exodus of Wall Street investors from the Florida housing market. Whether you're a potential home buyer, a seasoned investor, or simply someone interested in the future of real estate, this video is packed with crucial information you can't afford to miss. In just the past 6 months, these Wall Street giants have listed over 20,000 single-family homes across the Sunshine State, marking a staggering 35% increase compared to the same period last year. But it's not just the volume that's raising eyebrows, it's the pricing strategy. According to recent data from industry leaders Zillow and Redfin, the average listing price for these properties sits at a whopping 15% below their estimated market value. This aggressive pricing isn't limited to small players either. Major industry titans like Blackstone, Invitation Homes, and American Homes for Rent have been leading the charge, dramatically reducing their Florida portfolios by an average of 18% since January. These numbers paint a stark picture of a market in flux, with some of the biggest names in real estate investment seemingly rushing for the exits. These numbers paint a stark picture, but what's driving this sudden shift? To understand the full story, we need to rewind and look at how we got here. The rise of Wall Street in Florida real estate. Following the 2008 financial crisis, institutional investors saw an opportunity in the distressed housing market. Florida, with its sunny beaches and booming population growth, became a prime target. By 2015, Wall Street firms owned nearly 7% of all single-family rental properties in the state, well above the national average of 2%. The influx of institutional money had a profound impact on Florida's housing market. Between 2012 and 2022, home prices in the state surged by 120%, significantly outpacing the national average of 85%. During the same period, rental rates in major Florida metropolitan areas increased by an average of 45%. Additionally, the home ownership rate in Florida declined from 69.4% in 2006 to 65.5% in 2022. For years, this strategy seemed bulletproof. Florida's population grew by an average of 1.5% annually, fueling demand for both rentals and purchases. The pandemic only accelerated this trend, with remote workers flocking to the state in droves. The tide is now turning, and several key factors are driving this sudden reversal. First, the Federal Reserve's aggressive interest rate hikes have significantly increased borrowing costs, with the average 30-year fixed mortgage rate more than doubling since 2021, rising from 2.65% to over 6%. Additionally, a recent study by Florida Atlantic University indicates that homes in major Florida markets are overvalued by an average of 33.5% compared to historical trends. Meanwhile, Florida's property insurance market is facing a crisis as premiums have surged by an average of 33% in the past year, with some homeowners experiencing increases of over 50%. Growing concerns about climate, particularly the increasing frequency and severity of hurricanes and flooding, are making certain areas of the state less appealing to long-term investors. Finally, new regulatory changes aimed at reducing investor activity in the housing market have been proposed in several Florida counties, creating uncertainty for institutional players. These factors have created a perfect storm, prompting Wall Street investors to re-evaluate their positions in the Florida market. But what does this mean for you, the viewer? Market statistics and analytics. Let's dive deeper into the numbers to get a clearer picture of what's happening. 1. Inventory levels. According to the latest data from Florida Realtors, the month's supply of inventory for single-family homes has increased from 1.3 months to 2.7 months year over year. While still below the 6-month supply considered a balanced market, this represents a significant shift. 2. Days on the market. The median time to contract for single-family homes has increased from 12 days to 31 days year over year, indicating a slowdown in buyer demand. 3. Price reductions. Multiple listing services (MLS) data shows that 28% of active listings in Florida have had at least one price reduction in the past month, up from 12% at the same time last year. 4. Investor activity. Buyers and institutional investors accounted for 28% of all Florida home purchases in 2022. In the first quarter of 2023, this number has dropped to 19%, indicating a pullback from these large buyers. 5. Foreclosure activity. While still below pre-pandemic levels, foreclosure starts in Florida have increased by 67% year over year, according to Adam Data Solutions. This could be an early warning sign of market stress. The sell-off in Florida's real estate market isn't occurring uniformly across the state, though. Some regions are experiencing more intense activity than others. In Orlando, there's been a 42% increase in corporate-owned property listings, many of which were short-term rentals, indicating a potential cooling in the vacation rental market. In Tampa Bay, institutional investors are offloading properties at an average discount of 13%, particularly in suburban areas. Jacksonville, which experienced a surge in investor activity during the pandemic, now has 31% more investor-owned properties listed compared to the previous year. Even South Florida, a traditionally strong market that includes Miami-Dade, Broward, and Palm Beach, is seeing shifts. Condo listings from corporate entities have increased by 28%, with many sellers offering concessions to attract buyers. Opportunities for home buyers. If you've been priced out of the Florida housing market in recent years, now might be your chance to enter the market. Here's what you need to know. The inventory of available homes has increased by 22% year over year in major metro areas due to investors offloading properties, giving buyers more options than before. Additionally, price reductions are occurring on 35% of listings, with an average discount of 5.8%, providing potential deals for individual buyers, though it's important to thoroughly assess the reasons behind these discounts. Buyers now have more negotiating power as the average time a property stays on the market has increased from 22 days in 2022 to 45 days in 2023. Allowing for more flexibility in price and terms. Furthermore, the intense competition of previous years has diminished, with bidding wars and all-cash offers becoming less common. Only 35% of homes in 2023 have received multiple offers, down from 60% in 2022. However, caution is advised, as there is a possibility that falling prices could result in buyers being underwater on their mortgages in the short term. But before you rush to buy, consider these potential risks. 1. Further price declines. If this is indeed the beginning of a market correction, prices could continue to fall in the short to medium term. 2. Insurance costs. Make sure to factor in the rising cost of property insurance, especially in coastal areas. 3. Interest rates. While rates have stabilized, they remain high by historical standards. Consider the long-term affordability of your mortgage. What about investors? For those looking to invest in Florida real estate, the current market presents both opportunities and challenges. 1. Discount properties. With institutional investors selling at discounts, there are opportunities to acquire properties below market value. 2. Rising rental demand. As home ownership becomes less affordable, demand for rentals is likely to increase. The average rental yield in Florida is currently 6.2%, above the national average of 5.4%. 3. Long-term appreciation. Despite short-term volatility, Florida's strong population growth and limited land supply suggest potential for long-term appreciation. If you believe in the long-term prospects of the Florida market, the current pullback could present buying opportunities. Florida's population growth and status as a tax haven continue to make it attractive. However, investors should be cautious for the following reasons. 1. Cash flow challenges. Higher interest rates and insurance costs can eat into rental properties. Conduct a thorough cash flow analysis before investing. 2. Regulatory risks. Keep an eye on potential new regulations targeting investors, particularly in hot markets like Miami and Orlando. 3. Flipping challenges. The days of easy profits from quick flips may be over. Investors looking to flip properties should be prepared for longer hold times and more modest profit margins. 4. Alternative strategies. Some investors are pivoting to strategies like rent-to-own or lease options, which can provide more flexibility in uncertain markets. 5. Market timing. Trying to time the bottom of the market is notoriously difficult. Dollar cost averaging into real estate investments over time might be a more prudent strategy for some investors. The bigger picture. Taking a broader view, the implications of this trend extend beyond Florida. As a bellwether for national real estate trends, a significant downturn in the Florida market could foreshadow challenges in other overheated markets across the country. With real estate and construction making up nearly 15% of Florida's GDP, a market crash could have a widespread economic impact on the state. Additionally, more affordable housing might reverse the decline in home ownership rates, particularly among millennials and Gen Z. Local and state governments may also respond to a potential downturn with initiatives focused on stabilizing the market and promoting affordable housing solutions. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Is this really a crash? It's important to view this sell-off in context. While the signs may be concerning, the current situation is not mirroring the conditions that led to the 2008 housing crash. Lending standards have remained relatively strict, and there isn't the same level of subprime mortgages in the market as there was back then. Additionally, Florida, like much of the country, still faces a housing shortage, and this underlying demand could help cushion any potential price drops. The state's population growth remains robust, with a 1.9% increase in 2022, surpassing the national average. Moreover, Florida's economy is now more diversified than it was in 2008, with expanding tech and finance sectors complementing tourism and real estate. However, the rapid shift in market conditions and the retreat of institutional investors are significant factors that warrant attention. What's next? Let's consider some potential scenarios for the future of Florida's real estate market. One possibility is a soft landing, where the market cools gradually and prices stabilize without a dramatic crash, leading to a more balanced environment with minimal economic disruption. Another scenario could involve a sharp correction followed by a quick recovery, much like the rebound seen after the 2008 crisis, offering opportunities for both homebuyers and investors who can time the market effectively. Alternatively, the market could experience a prolonged slump with declining prices and reduced transaction volume lasting for several years, potentially causing the most economic damage. Lastly, there may be a bifurcated market where some parts of Florida remain resilient while others see more substantial declines. The reality is, no one can predict the future with certainty, but by staying informed and understanding the forces at play, you can make better decisions whether you're looking to buy a home, invest in real estate, or simply understand the economic forces shaping our world. Here are some important points to keep in mind. Stay informed by closely monitoring both local and national market trends. Knowledge is key in navigating real estate. Make sure to do your due diligence, as thorough research is essential in today's volatile market. Whether you're buying or investing, consider your long-term goals and avoid letting fear or FOMO drive your decisions. Instead, focus on how your personal or investment objectives align with current conditions. Seeking professional advice is also crucial, so consult with real estate experts, financial advisors, and local professionals before making any major moves. Finally, be prepared for potential opportunities, as market changes often create favorable situations, and you'll want to be ready to act if the right one arises. Thank you for joining me on this deep dive into Florida's real estate market, and please make sure you subscribe if you enjoyed the video and watch this one as well.